Now I'm officially halfway through my 30s, I've been realising how much easier investing is for me now than when I was in my 20s. In fact, I've over doubled my portfolio from £100,000 in my 20s to £250,000 today, and I hope to do the same in my 40s up to £1 million in my 50s. And I wouldn't say it's because I've earned more money, because I actually added more to my investments in my 20s and was way more aggressive than I have been in my 30s. So I want to share these with you so you can implement them too, perhaps earlier than me, and hopefully end up in a better position than I am, because I wish someone would have done this for me. First is I really abuse bonuses now. When I was in my 20s and I started off investing, I prioritized investing into my ISA to get as much tax-free gains as possible, and that's really what attracted me. I didn't want to pay any tax on my gains or when I take my money out, which I think is a completely fair argument. The word pension seemed ridiculously boring and something I wasn't really interested in, which I think is the same problem that exists today. Not to mention, I didn't have a clue what SIP, self-invested personal pension, actually was, because no one ever bothered to teach me, despite 18 years of education. The Resolution Foundation found that 13 million workers, or 2 in 5 working age people, aren't putting enough money into their pension to meet the minimum level for an adequate retirement, and they measure an adequate retirement as at least 2/3 of a worker's pre-retirement income. But to be honest with you, I think those numbers are hedging on the safe side. The vast majority of people I speak to just simply won't have enough. When I created a detailed breakdown of how much you needed to have invested by age, across the board people were way under what they should have. And it wasn't just people in the younger age bracket. Even in the higher age bracket, people still just didn't have enough. The reality is, and what I think the vast majority of people don't think about, is that the state pension just really isn't enough. This is what terrifies me, with more people opting out of their workplace pensions. Think of it like this: if you had £221 per week now, would that be enough? I mean, I spend over £100 a week on food alone, not to mention council tax, energy bills, fuel, day-to-day expenses. It probably wouldn't even cover that for me, unless I was to vastly reduce my costs, which isn't the type of retirement I want to live. And let's not forget that the retirement age is going up to 67 before you get this, and then will likely rise to 68, even with talks of it going up to 71, which hopefully won't happen, but I wouldn't be surprised if it did. They try and sell us this sham that life expectancy is going up, which, fair enough, it may be statistically, but what about the quality of that life? It was 65, so they take 6 years away from us, and they're trying to tell us that 65 to 71, are they really expecting us to have 6 more years of the same quality life in our 70s? I really don't think so. It really irks me that they try and push this onto us. Now, I'm not saying this to terrify you, which it should, to be blunt, but I'm telling you this because I want you to abuse bonuses like I am, so you can get to the best retirement you can as fast as possible. You can take your private pension from age 57 and free up 10 more years of your life not to work, which is huge. But you need a fair whack to retire at this age, because the earlier you retire, the more money you need to last you. And this is where abusing bonuses comes in, and it's how I've been able to grow my investments faster to reach my goal. When I invest, I get bonuses on everything I add from the government. I always fill my lifetime ISA, and I get £1,000 given to me every year, a 25% bonus on what I contribute, and that's completely tax-free, which is huge. So even when I take that money out in the future, I don't need to pay any tax. That's only £4,000 per year, but it gives me a £1,000 boost every year, which does add up, especially as that free bonus is getting investment gains every year too. Alongside that, I also prioritize my SIP, which stops me paying 40% tax on any higher earnings, but it also saves me 20% income tax on basic rate, which is given back to me as a bonus. This is either classed as 20% of the money earned, or from my point of view, I find it easier to look at as a 25% bonus too. This account has a huge limit of up to £60,000 per year at the moment, made up of £48,000 that you can add, and up to a £12,000 bonus if you're lucky enough to be able to add that much. I've never hit that, but it's nice to get that extra 25% either way. So between those two accounts, I'm accelerating my investment gains by 25%, which will get me to that goal much quicker. And it's actually more than 25% when you think about the compounding benefits over time of that bonus. So for example, previously when I was really heavily into investing, I would invest £20,000 in a year, which was a ton of work to do. But if I would have put that into a SIP when I was say 25, I would have gotten back £5,000 extra as a bonus in a SIP compared to putting it in an ISA. But that extra £5,000 now over the past 10 years years would have compounded to over £10,000. And this will probably shock you, but over 40 years that would be £81,557 by age 65. And that's not me adding any extra money, it's just because I chose to put the same amount of money in a SIP versus an ISA. And this is often what people forget about. It's not just the bonus, but it's how that bonus grows over time, which makes the huge difference. Don't feel bad if you have been putting your money into an ISA, because it is way more flexible. But I can't help but kick myself that I didn't take advantage of the bonuses sooner. You may be thinking I'll have to pay tax on the SIP, which is true, but when you do the calculations, even with the tax paid, the SIP is far superior as an account. I've created a more detailed breakdown on this, I'll link at the end of the video, along with how much you should have by age, so you can check them out after this one. The next thing that really helped me is regular investing. This may have different names depending on which platform you're using, but I use regular investing on Hargreaves Lansdown, and I've also got something set up called a savings plan on Invest Engine. So I've got one set up on my ISA here for £500 per month. If I go into it, you can see I've got £500 coming out every month on the 14th, and I've got auto invest turned on, which means that money will be automatically invested to my portfolio each month at the set percentages that I have. So for example, I've got 90% in the developed world fund and 10% into the emerging markets fund, and it will keep that split for me, so I don't need to worry about rebalancing my portfolio all the time to keep it how I want it. This allows me to be more consistent with my investing, which I'll admit in the past I've been pretty sloppy with. The reason is I just get so busy with other tasks and ideas. It's so easy to miss a month or two when investing, and I should be investing automatically. As you can see here, if I go back to my all-time view, you can see there's been periods where I've not invested consistently. So by having the auto invest turned on, it will fill in the gaps and make sure I invest where I need to. Investing in this way means I can be way more consistent and make sure I average into the market properly. I've had a few occasions where I was annoyed that I didn't buy and I forgot to buy when I should have and I missed out. A few times it has worked in my favour, but more often than not, I would have been better being way more consistent. In my 20s, I would often just put huge chunks of money into my ISA in one go, 5, 10 or £20,000 in some cases, right at the end of the tax year, when I had the cash available, which was fine, but it wasn't averaging into the market very well. Some years I would even wait the entire year before that £20,000 came back up from when I invested it. So I was completely missing out on when the market was down and the chance to buy more, which is completely wrong. So if you haven't already, set up a savings plan or regular investing, as it takes minutes and it's way worth doing. This leads on to something which I've never been very good at until recently, which I'm happy to admit, and it's budgeting. I have never created a budget in my life, which is probably pretty stupid. I think the majority of why is just that I've been self-employed for my entire adult life. I've never had what you'd class as a proper job, other than a couple of small Saturday jobs where I worked in a bakery, and a small stint in the summer where I essentially ran a clothes shop while spending hours editing images for their website too. Essentially 2 jobs in one, but under minimum wage. Yay. But what this means is I've essentially never had a fixed salary, which, as you can imagine, makes creating a budget pretty hard when you don't know how much you're going to get paid. In some ways, it's been a blessing and a curse, because it's forced me to be very safe with my money, hence why I put so much into my investment ISA over the years. But what this hasn't done is given me any sort of balance when it comes to planning my investing journey, and knowing how much I can save and how much I have to spend. To fix this, I've done 2 things. I've created a base amount of what I think I can manage to affordably invest each month, while focusing on other things. So I'll have a set amount I'm investing into my account each month as a baseline, like you just saw £500 into my ISA every month, and set amounts into my SIP on my lifetime ISA, which could be more or less depending on how much I actually need to be investing. What I can do then is adjust the amount as I go along. So if I need to invest less, say I need the money for a new bathroom, or just haven't got enough that month, I can do so. Or if I need to invest more to avoid higher tax, I can increase it that way. Having a baseline makes it way more flexible for me to account for what I'm actually investing, and also frees me up to spend more money on other things and actually enjoy life along the way, which often gets lost in this investing journey. The second is I've created a breakdown of how much I need to invest, so I can benchmark it against where I'm up to, so I can see how on track I am versus my target for my age, based on how much I want in retirement. This way I can work out if I can invest less or have a year off from investing without stressing if I'm ahead of schedule. I've had a few people ask me how to do this, so I've created a step-by-step guide which I'll pop in the description down below for you. The next couple of points go hand in hand and have been really helpful in growing my portfolio, and that's been changing how I actually invest. In my earlier years investing, I was really keen on picking the right type of investments that I felt could outperform the market, some of which in the past has gone really well for me. And I had years where I outperformed the market quite significantly, but I also had years where I completely underperformed the market just by making a couple of bad decisions. Even though I'd gotten all the right metrics in place in my mind, company profitability, direction, and it all had the right signals that the company was a buy, one unexpected problem would crop up and wipe out the profit for the entire year. Or, as I famously mentioned, buying right before a war.
Russia's full-scale invasion of Ukraine, the largest invasion of a neighboring country in Europe since World War II.
Where I've actually had the best returns is switching to a hands-off ETF approach, and that's because it freed up my mental capacity to focus on making more money and funneling it right into investments. For example, this last year, my portfolio is up 23.27%, which is crazy, and I've made £25,282, and this is just my ISA account. Between my accounts, I'm up over the average UK salary, which is just mind-blowing. I mean, let's not forget, it could be down just as easily that same amount too. But that's no stock picking, extreme metrics, that's just the absolute average that anyone could get. This is why I can't stress enough, putting in the work early will pay off. I wouldn't be making this much if I hadn't gone so full force early on. And that's what's really exciting, is how much potential this can have to grow in the future too. It's also quite depressing to think how some people inherit millions and they're already at my endgame level, but that's another story. So I'd really encourage you to do the same. Although I get loads of people saying to me, just buy Bitcoin, buy Tesla, or check out this latest stock. That's fine. But get the vast majority of your portfolio in ETFs early on and let that compounding work without hassle. Now, part 2 of this, which has been a game changer for me, and honestly why I don't think I'll ever end up changing platforms for some time, unless some other providers get this feature too, is a portfolio look-through tool. Because the main thing that kind of annoys me about index funds is that on most platforms you will just see the index fund and it's moved a bit and you don't really know what's going on. With Invest Engine, their portfolio look-through tool is my absolute favorite part about the platform, and if you haven't seen it, you should really check it out. If you go into analytics and then over to holdings, you can see how much you've got in each individual company. So I can see I've got 5.7k in Apple, there's Microsoft, and all the big Magic 7 stocks. So while I might feel like I've got FOMO and I've missed out on the gains these companies have made, I can see I've actually thousands invested in them anyway, as well as looking at smaller companies I didn't even know I had holdings in. I can even go super specific, like take a look at what companies I've got within the technology sector in Japan, companies like Toyota, Mitsubishi, and Sony. Or I can even look at what holdings I have within the UK. I've got nearly 4,000 companies by just holding 2 index funds, which blows my mind. But it's really nice to see that more exists within these rather than just seeing those 2 titles. For me, this makes investing seem way more engaging and interactive while still having those safe investments. While it might seem super fun to buy individual stocks and you might get some luck, it's when your luck runs out that's the problem. Trust me, from 15 years at this now, I would definitely just suggest index funds. I'd be way better off if I just stuck to them. Don't waste your time worrying about monitoring stocks, instead just put that time to good use and use it to start a side hustle or make some extra money or just enjoy your life. Investing, although it seems like quite a primary focus, should always be secondary and something you can have running on autopilot in the background, because short-term movements really mean nothing, and it's just time that will build your wealth. I really hope these points will help make your investing life easier too. If you have something that's really helped you, do me a favour and share it in the comments, as you never know, it might help someone else. We're all in this together. If you want to see how much you should have invested by age, you can check out this video, or if you want to see the difference between an ISA and a SIP and how they really stack up, make sure you check out this one because it will really help you, and I will see you over there. Thanks.